Hello and welcome to Frugal Finance. We're just going to do a quick video today on the difference, pros and cons, etc. for opening a pie or investing in individual stocks. So without further ado, please do press the like button. That helps the channel get out to a wider audience. And if you would like to follow the Trading 212 portfolio here and various other investment ideas and general wealth building and being frugal, please do subscribe to the channel and feel free to comment below if you've got any questions. So without further ado, let's get stuck in. So what's the difference between a pie and an individual investment? So with Trading 212, they do a thing called pies, which is basically like a segment of the market. So if you go into the pie section of the app, you can see that people have created pies already. So you can buy them in EVs and green energy, you can buy growth pies, dividend pies, you can even make your own, obviously, tech, all that kind of stuff. And what they are, they're groups of companies into a pie, basically. So like here, for example, we've got House Deposit. So this person has created a pie, named it House Deposit, and it has got 5 stocks in it. And you'll see that there is these kind of colours in the pie, and that is the percentage that goes into those particular stocks when you buy them. So basically you can see here that when you put in money, you get 8% of the money that you put in goes into Apple, 20% into Tesla, and 22 and 24, 26 in the other shares. So if you put £100 in, obviously you're going to get £26, £24, £22, £20 and £8 across those 5 shares. Obviously you can either copy other people's pies, or you can create your own. Now, there are plenty of pies to choose from, lots and lots of them. I think the maximum you can have is 50 stocks in there. Now, there's a benefit and a disadvantage of having too little or too much. So if you have too little of stocks in there, obviously what's going to happen is that your market is still quite easy to fluctuate. So if you've only got 5 stocks, then obviously your pie is not that dissimilar to actually investing into individual pies. But if you've got, say, 50 stocks in your pie, then that is actually closer to probably like an ETF or something like that. So it's minimum risk, but you won't get the same amount of profit back out of it. So that's something to consider, and I would say you need to have a look at your kind of risk appetite and exactly what you want to get out of it, whether you're going for dividends or growth stock, essentially. But obviously you can become too diluted or not diluted enough. So that's the advantage or disadvantage of pies, is that you can make them so little a pie, if you like, the slices of the pie, that they're almost individual stocks, or you can dilute it far too much. The ease of it is that if you just stick 100 quid in there, it will just automatically spread it across all those investments at that percentage. So it saves you. So say if you just want to invest £100 a month, it saves you kind of having to flick through all of your individual stocks to find the ones that you want to put that money into and allocating that as a percentage term. It's sort of ETF almost investing if you've got more than, say, about 20 stocks in there. So flipping back over to the normal side of the investment, that is literally just buying individual stocks and shares. So for example, buying a share in American Express, that's not in my pie. I have to buy individual shares. Obviously you can buy fractional bits of the shares on some of these ones, and you know, the reality is obviously if American Express was to go into administration or go bust, or have some accounting error announced or something like that, this share price would go down significantly. So obviously you would lose quite a fair chunk of this money that you've got in here. However, if this stock goes up, it's obviously you've got a lot more money in it. So let's say one share is almost £100 at the moment. if that goes up 5%, then obviously it's going to go up 5% on £100. If it was in a pie, it would go up 5% still, but it would be obviously a lot smaller amount, because the £100 that I put in, remember, that's going to be divided over, say, 20 odd stocks. So it's only going to be a few pounds, and your 5% on your few pounds is a lot less. But if there's a market fluctuation and the share price goes down, it's obviously going to do the same. So the moral of the story really is that individual stocks, obviously the potential for growth or bigger dividend payments is much larger, but the potential for it to go wrong, if you like, is higher. So you need to kind of do your own investments as to what your risk appetite is, and really try and manage your portfolio around that. You can be too diversified and not diversified enough. So and then obviously, depending on what you do, it's always good to have a diverse portfolio. And what I mean by that is not have, say, all of your money in banking or all of your money in real estate or equivalent. Because obviously there are different sectors, and those sectors themselves go up and down. When there's a property crash, the real estate stocks and shares tend to go down, generally speaking. So I hope that's a really useful insight into exactly what the difference between pies and investing individually is, and really what the risks are involved in that, and what returns you might expect. I'll give you an example here. 3M, obviously I've got £12.53p in with them, and it's a relatively stable stock. Over a year it will kind of go on a nice even keel up, but you see in the last year it is up 11%. And pretty much since I've owned it, it is around about 3% increase, or 1.87, sorry. So that's a pretty healthy return on that. I know I haven't got a lot of money in there. So that's in comparison to, say, if you were to buy a individual stock, so like Cineworld Group. Obviously, whether this is a stock I believe in long term or not, see my other video specifically on this stock, but you'll see even today, it's up 2.4%, and over the week it's 15%, and over the month 30%. So me personally, I'm up just over 30% on this stock. But again, it's Cineworld Group, isn't it? It might go tumbling back down again. So, it might be a time to cash out, or you hold these stocks for a long term if you believe in the companies, that sort of thing. So, that gives you an idea of the difference between, say, 3M, where I've put money in through the pie, and then Cineworld, where I've put money in individually. And you can see the amounts there differ. Even though in the pie there's overall is about £600, obviously a small percentage of that is given to 3M, as opposed to half the amount, which is the cost, if you like. So the 450 shares are currently worth 381. I obviously haven't paid that for it because it's up £88. But that's obviously significant increase, but percentage terms that's quite heavily weighted on the portfolio. If you look at the bottom here, Cineworld Group is actually one of the biggest holdings that I've got. So so hopefully that gives you a pretty good insight into the difference between an individual stock and, say, using the pie feature. As I always say, you must do your own research. You must seek independent advice. I'm not a financial advisor. I'm just a guy on YouTube doing these videos for entertainment purposes only. So please do consider your options before investing in the stock market. Having said that, if you would like to invest, please do use the links below. You can get up to £100 worth of free stock from Trading 212 once you open an account and credit some money. So if you use that link, then you will get up to £100 worth of free money. So please, if you are considering, do use the link. Help the channel grow, obviously, and show some support. And you can do that also by subscribing, liking, and commenting below. Until next time.